All right. Again, welcome everyone to today's call. As always, there's quite a bit to cover, and there's a couple of announcements that I am going to make as well. So, as we get going through here, obviously the first announcement is we are starting tomorrow. We are 2 weeks away from the seminar starting. It, of course, starts on a Friday morning. It'll go most of the day on Friday. It'll start up again on Saturday morning and go most of the day on Saturday morning. And the live trade call that week will be on Friday, not Thursday. And it will actually be part of the seminar. And so if you have not upgraded, obviously, again, you really want to upgrade to a 1-year subscription, Call Spring, to get that done. In the seminar, of course, we will be going through triple play option patterns, a lot of different patterns that we'll be talking about, and going in detail about how to put these patterns together, the processes, the logic behind it, the traps, the relationships, everything that you need to know about this approach. And then we'll also be talking extensively about profit stacking, these types of patterns specifically. I've done profit stacking stuff before in the past, but not with regard to these particular patterns. So that's what it is going to be focused on. It's going to be a tremendous seminar. So make sure you call Spring, upgrade, and or sign up for the seminar. For those who are on today's call for the first time, welcome. If you are new, I do want to caution you though, I don't explain everything on these live trade calls. It is impossible for me to explain everything on these live trade calls. I can barely get past the initial couple of different trades that we focus on every week, which I'll be talking more about that here in a minute. But if you are on this call for the first time, you're expecting to be fully explained everything that we're doing. That's not what this call is for. It is for my subscribers who already understand the approach. It's just simply a starting point for you. You need to attend these calls on a regular basis, and believe me, it will all become much more clear as you get through. Now, if you are new, the trades that you're going to see and the trades that we take, they are absolutely fantastic trades. It's another profitable week this week. But regardless of how great the trades are, you need to start small. Okay, you need to start small. You start small because you're going to probably make mistakes at the beginning. And you're going to not understand everything. You're going to hear me talk about a lot of stuff, and then you're going to take a trade and you will have made a mistake, or you will have not listened or understood necessarily to what I said, and it will click and you'll say, oh, that's what he meant when he said this. And so you want to go through that process. You want to start small. You don't want to be reckless with how you put these trades together. You can't just put together any old bearish and bullish pattern and expect to have super high probabilities of success. You have to be very intentional about how you put these trades together. And then you always want to follow instructions. Even when I don't follow my own instructions, which I did 6 or 7 weeks ago, and it came back and it bit me in the butt pretty hard. Didn't follow my own instructions. It was the dumbest thing ever. I was so angry with myself, still am, that I did that. Nonetheless, these are great trades, but it doesn't mean you throw caution to the wind. All right. One of the reasons that I say that you want to start small is because of the compounding. And I know some of you who have been on these calls since April, and you've seen this compounding table every single time. Well, you might get sick of seeing it, but I absolutely need to keep it in front of you, because that's what creates wealth, is this compounding table. And so this particular compounding table, once you begin the process, if you can average just $100 a month for 6 weeks, or excuse me, $100 a week for 6 months, I'm getting everything backwards today. It should be a great call for you guys. uh, after, if you can average $100 a week for 6 months, you're talking about growing your account by about $30,000. Now, you're probably not going to average $100 for the first 6 months. $100 a week for the first 6 months. You're going to have to start off slow, and then you'll slowly be able to increase that profit potential. And I'll be talking about that a little bit today as well, because a lot of you are doing great with smaller profits. Now we're going to be talking about how to maybe increase those a little bit. So after 6 months, you're talking about $30,000 in profits. That's tremendous, tremendous based on the compounding. But after 5 years, you're talking about growing a very small account into approximately 3.4 million. Again, that's if you can average $100 a week over the course of 5 years. So your goal, of course, should not be to average $100 a week immediately. Your goal should be to be profitable immediately. And then you increase that profitability. Okay, now having said that, I've said that many times over these calls, and based on feedback and based on questions that I've gotten, and as I'm viewing the problems that some of you have had, or maybe even still are having, I have put together a report, and the report is coming out later today. You're going to see an email on it, and the report is called The Blueprint That Gives You a 98% Probability of Becoming a $1 Million Trader. And in that report, I detail the exact processes that you need to go through. I've put it all together. I've put it in a, and no one has seen this yet, by the way. So this is not something that I've come out with before. This is something that I just basically sat down and put everything together so that you have the highest probability of experiencing immediate success. If you have not already, and I know many of you have had some tremendous successes, and so this may excuse me, this may help you increase your efficiency as you venture into other patterns and other ways of implementing this. But this is the one that if you are still having problems getting started, you need to get this pattern, this report. Now, if you're on this call, you get it for free. Right. So when I say you need to get this report, what I'm actually saying is you need to take the time and you need to read this report. And it uses and utilizes what we've been talking about here, but it's not like the quick reference guide that I created for you guys. It is literally a step-by-step process. Okay, you're not experiencing success, you're doing something wrong. Okay, it's not the strategy, it's not the approach, you're doing something wrong, because I've only had one losing week. I shouldn't say that. In one account, I've actually had 2 losing weeks, but I've only had 1 losing week in like the last, 4 months, 3.5 months, something like that, with most of these trades. Some of them have been very good, like a $12 winner, or a $5 winner every now and again because the market tanks and whatnot. But this is something that will get the foundation underneath you. You have to have the foundation. So if you're on this call, you get it for free. It's going to be posted on PDS Trader later today in the TPO section. You'll have access to it there, and you'll probably also get an email with it. So there's because it's a link on PDS Trader, and so you'll have the ability to do that. And I think for many of you, I think it will be something that absolutely simplifies stuff for you. All right. So, let me see here. The pattern that I focus on in this report. So it's not just a processes in general, it's also a process for this particular pattern. And I've created the process for this particular pattern, and it's basically what we've been doing the last 5 or 6 weeks. And I'm isolating that pattern now, and I'm creating my $1 million option pattern. And I'm going to be isolating several of these patterns as like a template. And I believe, Keith, I think you're the one that asked me about whether I was going to be doing that in the last call, and that absolutely is. So this is an example of me isolating a template pattern, and so I give it a name, $1 million option pattern. And so every time I talk about the $1 million option pattern, you're going to know exactly which template that I'm talking about. And I am going to be doing that with several of these patterns to help you guys out throughout the seminar, and then after the seminar ends as well. So I have detailed the exact processes for taking advantage of this particular pattern within the processes of giving yourself a 98% probability of becoming $1 million trader over the next 5 to 7 years. Okay, now, again, the reason I've done this is because this pattern has dominated our calls. It's been a great pattern that it's been a great go-to pattern. I took the first trade in this particular pattern, a slight variation back in January. That's when I finally was able to put the proper bullish pattern, the proper bearish pattern together. I've been improving on that a little bit since then, but it's been consistently available. And it has also obviously dominated the calls over the last 5 to 6 calls, and rightfully so, because it's one that I think is one that needs to be a go-to pattern for those of you who are just starting with this process and whatnot. And I also wanted it to be a mainstay go-to. So if you're looking at other things, if you're looking at other patterns and whatnot, and you can't seem to find something, that this will probably be available. And it's kind of like, okay, there's really nothing. I was looking at other, this other type of pattern, but I can't get the prices. So let's look at this one. Let's go back to the $1 million option pattern and see if we can do it. So it has dominated the calls, and rightfully so, but I want to use these calls for additional ideas. I want to use these calls for different patterns. I want to use these calls for profit stacking techniques and the enhancing techniques. I don't want to just cover this particular pattern every single call because it will probably be available in some shape, fashion, or form on every single call. So I want to kind of move that one out of the way while not completely not focusing on it either, right? I don't want to skip the pattern during the calls because it is something that, again, everybody can begin to take. So what I did is I've actually added a monthly call. It's a monthly, not a weekly call, but it's a monthly call where I'm going to focus specifically on the $1 million option pattern. And I'm going to be talking about previous pattern trades that we've taken with the pattern over the last, over the previous 3-4 weeks. I'm going to be talking about the pattern now, any changes that might be made to how we're executing the pattern based on current market conditions, et cetera, et cetera. So I will dedicate a single call once a month to this pattern so that we can have a little bit more freedom to use these calls to continue expanding your understanding of all of these different processes. All right, so that call will be every third Friday is how I'm scheduling it right now. Every third Friday at 11 a.m. Eastern. Okay, so the first one is actually tomorrow. You probably already received a notification in PDS Trader about being able to sign up for this tomorrow. You don't have to attend it tomorrow. Obviously, we'll be covering a lot of this today, but this is something that is more akin for my newer traders, if you will. Obviously, you can attend the call every Friday. You can attend as often as you want, since you're a subscriber. Again, no additional costs. No, you don't have to pay for anything else. You're already subscribed to this extra monthly call that I'm going to be doing. Okay. Now, because of this, through next week, the calls that we do are going to remain fairly similar. I'll touch on different aspects of what we're doing. I might throw in, another pattern, another variation, or whatever. But I'm not going to go extensively too far out from what we've been doing. However, after the seminar, then I will begin to use the calls to diversify into these other areas more extensively. So that's kind of a change in plan in how we're going to use these calls. And I'm going to actually try and create a schedule for these calls so that we cover one topic extensively, for example, in August or September. And then we cover another topic extensively the following month, and maybe another topic extensively the following month. And that may be how we do that. And obviously never abandoning the process of what we're doing, and here's the best opportunity that is available and whatnot. But that's kind of where I think I'm going to take these calls in order to maximize your benefit out of them, as well as to make sure that you can see the trades that I'm actually taking within each of these. All right. Now, one last thing. After the seminar, like immediately after the seminar, I'm going to be taking a 2-week vacation and will not be holding live calls. So the last live call will be July 31st, and then I will take a 2-week vacation. The first call after that will be Monday, August 17th. If you obviously, because I'm taking this vacation, 2 weeks will be extended on your subscription, so there's no issue there. But I need a break, and so I'm going to be taking a break. Obviously, I'll still be trading. It doesn't take me hardly any time at all to make these trades. It does take me a lot of time to prepare the presentations, to explain them and to go over them and to plan, exactly what I'm going to do out. So that I'll still be trading, but I'm not going to be doing, the prep work, which is quite extensive. All right. So again, the pattern that I've been focused on over the past 5 to 6 weeks, I'm now calling my $1 million option pattern. It's what we've been taking. This is the trade that we took last week in the live call, and I'll throw up the graph here in a second, but I just want to do a quick update on this, because one of the things I want to address is something that I put in the report and the processes of the report, which is talking about exiting these trades. And so yesterday, right before the close, the market was trading at about 322, and as you can see, this trade was trading for about a $65 profit. Now, in Monday's call, some of you said that you were not filled on the bullish side of the trade, which I found odd, because I was actually filled on this particular version, because I took it many times, but I was actually filled on this particular version of the pattern like 2 hours after I sent out the signal last Thursday, or was it Friday? I don't remember which. Anyway, it was like 2 hours after that I got filled, so I should have had lower priority. And normally, at least what I'm told, is that if I place an order for a particular trade, and you place an order for a particular trade, if I place it first, my order takes priority of getting filled over your order. And so since I placed this like 2 hours after I had sent out the original signal, I figured if I got filled on this, everybody would have got filled. But apparently not everyone got filled. So I'm going to assume you placed it after I actually placed this one. If not, I have no clue then. But I said I was going to come up with an alternative during that call. I said I would take a look at things after the call, but by the time the call ended, the bullish trade, because the market was trading higher Tuesday, I was thinking it was like trading at 324. But by the time the call ended, this trade, the bullish trade was actually trading at 35-cent debit. So that should have taken care of everyone. Everyone should have been filled on the bullish side of that at that point. And the only reason you wouldn't have been filled is if you didn't have the order working and in place. So assuming everyone got into that or did something similar, because the market absolutely cratered within the last few hours of the call on Monday, giving everyone an opportunity to take a profit out of your bearish, neutral, or get into a bullish trade at that point for maybe even a much better price. Okay. All right. Now, this trade, as of yesterday, right before the close, the market had made a slight move to the upside. And this trade was sitting at about a $65 profit. Okay. Now, the bullish side of this trade, which is the order number 2, and it's up here in action group number 1. So I did this in a reverse order. Again, to show you that you don't have to take the risk of the bearish first. You can take the risk of the bullish first if that's what you want to do. However, again, the probability of success with the bullish, if that's all you're filled on, is not as high. If you get this, if you get filled on this bullish trade and the market begins to move down and never comes back up, and you're never filled on the bearish, you have a higher probability of realizing a loss. It is obviously limited, and so you can do the bullish, one bullish and then the bearish and then a second bullish, or you can do 2 bullish, at which point your risk would be $84 on that bullish side. Nonetheless, this was filled at 42 cents, and in this particular pattern, the bearish was filled like about an hour and 45 minutes after my bullish trade was filled. So this is one where it made me wait to get filled on the bearish side of it after I was filled on the bullish side. Nonetheless, at 42 cents, as of yesterday, right before the close, the bullish was trading at $1.70, or excuse me, $1.07. And the market, again, was trading about 322. And so the long was 3 points out of the money and was worth quite a bit, actually. And this particular trade on a per basis was $65 profit. The bullish had a $65 profit each, and of course I was in 2. So that gives me a $130 profit on the bullish. Meanwhile, the bearish had about a $60 loss. And so my net profit was actually $68, but after you get, if you try to get filled, you probably more likely would have gotten filled at like $65. There were a couple of times during the day where you could have got filled on a target of some sort of as high as $80. But nonetheless, that's what was available right before the close. Now, one of the things that I talk about in the processes in the report that I just put together is tracking these trades and getting out when you are comfortable getting out, and then tracking them to watch and see what the available additional profit is, or whether there is no additional available profit. And you need to understand the structure of these, because I think it's a mistake, and I've said this before, it's a mistake to get into these trades and expect to make the maximum possible profit, or to hold out until the maximum possible profit, which I will discuss here in a minute. Because at this point, when the market's trading at 322, which was right before the close yesterday, and I have a $65 profit on this particular trade, what is my risk. What's my risk at this point? Right, I'm holding on to a $65 profit. What's my risk? The following day, market tanks, goes down to, let's say, 317, 316, 315, somewhere around there. I can say goodbye to this profit. It's gone, okay? And unless the market makes a significant move to the upside, I probably won't see that profit potential again, okay? The other side, the flip side of that is that the market moves up and further into the profit zone. And if it moves up further into the profit zone, then what happens is that I probably have an open position profit of maybe $150 to $175. Again, we're talking about 2 days early, right? So if the market opened up this morning at, let's say, 325, I'm probably sitting on a $150 to $175 profit on this thing, which is about double what, about double my $65 profit on this trade. So if it moves up, I double my profit-ish, maybe a little more. And if it moves down, I may lose my profit completely because my trade price on this was zero, right? It was my cost basis was zero, so it could go back down to zero. It's probably not going to go back down to zero. I can probably pull at least something out of this. But my point being is that you're in an interesting spot on a Wednesday afternoon, right in the middle between the market going down or going through the major profit zone, and you're sitting on a 65. You basically have about an equal probability of either side, of the market going to either side. And on one side, you lose your profit, and on the other, you double your profit. Well, at that point, you no longer have a higher probability of long-term probability of gaining a bigger profit. And so the best thing to do is, if you have a profit at that point on a Wednesday, I shouldn't say the best thing, it's about the same. If you take your profit, then you remove the probabilities out of the picture, right? Half the time you're going to lose some of the profit, half the time you're going to, I shouldn't say half the time, part of the time you're going to lose the profit, part of the time you're going to increase the profit, and part of the time it's going to remain fairly the same, right? So if the market moves down, I can expect a little bit lower profit, open position, and if the market moves up, I can expect a little bit higher profit. All right, so that's where we're at. That's my thought process as I'm going through this trade, and we're on Wednesday. We've got 2 days left. An economic report coming out on Thursday morning. What do I want to do? We're right in the middle, and there is absolutely nothing wrong with taking a $65 profit on this trade because of the probabilities that you're facing from that point on. So this morning, market opens. Nothing major about the economic report that jolts the market. Market starts to come off a bit, and it's trading basically 2 points lower than it was Wednesday right before the close. And so all day it's been basically that. It's been between 319 and a half and 320 and a half most of the day in a very tight range. And because the market is trading down, my profit on my open position profit on this is lower. Now, again, I have a decision to make, because if the market stays the same, I'll probably make a little bit more money on this trade. And the reason I'll probably make a little bit more money on this trade is because of this credit right here. You'll notice that I was filled at an 84-cent credit, and right after the open this morning, the credit was at 85 cents. And so I'm actually losing 1 penny on that, but it's basically out of the money. It's right at the money. 320 is the highest point or the highest point of the profit peak, which we'll look at the graph here in a minute. So tomorrow, by the close, if the market's still trading at 320, then this trade is going to be at a debit. It won't be at a very big debit because that 324 long call is 4 points out of the money, and they are cratering the volatility in these right now. So it's not going to be at a very big debit, but it will be at a debit, which means that, let's say, it's probably going to be at about a $35 to $40 debit, which means that there's $120, $125 profit potential on my bearish trade if the market stays the same. If the market tanks, I'm going to make basically 85 cents on this trade. But if the market tanks, what am I going to lose here? Because this morning the market was trading at 65, the bullish trade was trading at 65. I'm basically making $25 a piece on it, so a total of $50. And by the time you get filled, it may be closer to $45, right? So the overall net position on this is $45. If the market moves up, I'm probably going to make more money. And so you can actually put in, some sort of target maybe on the long or on the bullish, or maybe one of the bullish, and go for a bigger profit on that. But if the market continues moving up too much, then then by tomorrow, this bearish might be a loss, right? So do you take the $45 profit, or do you not take the $45 profit? Well, if I were still in this trade, I would not take the $45 profit. I would wait for something a little bit bigger, but I wouldn't. I probably would not wait until the open tomorrow, because I could give the whole thing away. And so I would be more inclined to go ahead and get into another trade. Take the profit on this one, get into another trade, and start the process over. All right, now right before the call, the market again trading at about 320.50, and again I have about a $50 profit that I'm sitting on with that trade. And as of right now, 14:30, 20, it's sitting at about a $50 profit. Okay, now the issue here is this. You'll notice here on order 2, I've already, most of the extrinsic value has left the building on the 327 call. Yesterday before the close, there was still 45 cents on that, but the long was trading at $1.55. Volatility was being held into these options because of the unemployment report that comes out every Thursday morning, and that employment comes out, and all of a sudden they tank the value in the short and the long. So now the 327 shorts are at 15 cents, and the 325 longs, instead of being at $1.55, cratered all the way to 81 cents. Okay, so now if you get to the current value, you're talking about 7 cents is what this 327 is going for, which means that I really don't have any value in this bullish trade unless the market moves up. If the market stays the same, I'm not going to gain anything else from this 327. The only thing that I have is to lose money on the 325 long unless the market moves up, and it's going to need to move up pretty substantially. And so this becomes a factor in my thought process because at 325 tomorrow, if the market moves up to 325, the long calls will be worth about $200 total. So it'll be, the long calls each will be worth about $1.60, $1.70, maybe $1.60, maybe $1.70, which is barely $1 more. And on 2 of them, that would be about $200. So this particular trade, if the market moves up to 325, the entire spread is only going to be worth about $2. So the market needs to move up. It needs to move up significantly. And that's when this one comes into play. If it stays the same or moves down, it's going to start losing value. However, it's not going to start losing value quite as quick as this one, as the bearish, because on the 320, as of this morning, there was still, I was at the money, there was still $2 of extrinsic value. And so you're going to see this remain relatively the same. And right before the close, you might, if the market's still staying around 320, you might see this bump up right before the close as they begin to really crater the 320 calls. And I don't like holding on to these until right before the close because the probability of me closing right at 320 is going to be very, very small, right? So I am, I'm looking at a higher, I want to create a higher probability for myself and consistency and a methodical way to approach this. And so, you know, I'm looking to, if we're in the middle, I'm looking to exit these on a Wednesday afternoon. I'm looking to exit these things, take my profit, and you know, take another trade. If the market is trading down and I don't have a profit, or my profit isn't very big at all on a Wednesday afternoon, it's a no-brainer. You hold, because if the market moves up, then you're going to go into the profit zone. If the market is on a Wednesday afternoon is trading higher into the profit zone, then I'm going to want to probably exit one or both of my bullish trades and then open that thing wide open for any move to the downside. I just want to make sure that I take the profit that will cover most of my risk of my bearish. Okay, so that's the process on this particular pattern and how I go about determining when I'm going to exit. In the processes, I talk about, you know, if you're brand new to this, then I would get out at a small profit, $20. And then if you're comfortable with that, $30. And then if you're comfortable with that, $40. And then if you're comfortable with that, $50, 60, 70, 80, 90. By the time you get to 100, right? So you go through this sequentially each week. By the time you get to the $100 target, you're not going to be taking that target as often, which means that you'll be needing to make a time exit or based on you know, the market getting closer to the expiration. But that's all. I'm not going to cover that in too much detail right now. All right, so let's move the trade that we're in down here. And so this is, of course, the bearish at an 84-cent credit, and we're trading right at the profit peak of that bearish. And in order to realize that profit peak, what do we have to do? We have to wait until the very last second of the trade. And therefore, that makes this profit peak highly improbable, which is why you shouldn't play according to the profit peak, at least on the bearish side of this trade. I'm going to change the aspect of this so it's a little bit more realistic in how it looks based on probability of market movement. Okay. Now, in addition to that, at the very last minute, they're going to tank, last hour especially, they're going to tank the value of those longs, and those longs are not going to be worth, you know, whatever it is that they're projecting, which is at this point about 60 cents, and it's probably going to be closer to 40 cents. And maybe even a little bit lower, less than 40 cents. If it's four points out of the money and it expires on Monday and there's no announcement coming out on Monday, there's no reason for volatility to come into that. And so you're talking about dropping this profit potential down quite a bit. Here's the bullish side of it. Again, the profit peak is not going to happen. If it's at 327, it's not going to happen until the very last second. And it's a little bit different because the longs are actually in the money, and so it's not as detrimental with regard to the volatility coming out, because you have intrinsic value at this point. The longs are at 325, right? The longs are less than the short, but the short still represents the profit peak. So the longs will have intrinsic value here, and that intrinsic value, it'll be worth about probably 225 a piece, 220 to 225 a piece. Okay, maybe a little bit more. And at that point, the 327 will not be worthless until right before the close, and even then it's probably going to have 8, 9, 10, 11 cents on it, because they actually don't expire those options until Saturday. So they always hold a couple of pennies on there, 5, 6, 7, 8, 10 cents on there. So it's really not accurate from that standpoint. And of course, I'm in 2 of them, so you can just drop it down by 20 cents just from that alone. And then you can drop the volatility down just a bit, and the probability of the market closing at that profit peak is very, very small. All right, very small. And so we don't play this whole thing based on the profit peaks. And of course, if we combine these, this is what we're looking at. And there we go. If I drop the volatility a bit on these, we'll come up with a little bit different if we were to hang on until the last second. All right, so you see here, if you hang on to the last second, you might, and it might actually be a little bit lower than that, you might grab about $100. Between 320 and about 325, you might grab about $100. If I have a $65 profit on this thing on Wednesday, and the risk of the market giving all that back, and we being so far away from the profit zone of going bigger, I'm probably going to take the trade. I'm probably going to take the profit, okay, on that trade. Now, having said that, I want to take you back to something. And I want to take you back to the compounding table. Now, this trade, if you're able to put it on successfully, and I know some of you were filled on the bearish and then you weren't filled on the bullish until Monday. But if you place on this trade successfully, what's the maximum risk? Okay, this structure, by the way, if you follow the instructions and you place it on exactly the same week in and week out, and have a zero cost basis or maybe even a small credit, and it's exactly this structure, you have a max risk of $100 to the upside, no matter what. Okay, that's the max risk, period, end of story, and that's it. All right. What's the probability, given everything that you know, and given everything that I've explained to you and all, throughout these calls and with this trade, what's the probability of you realizing this $100 loss? It's almost non-existent. It's almost non-existent. And this particular compounding plan, so I'll pull that back out. This particular compounding plan is actually based on a max risk of about $200. Okay, I force you to be conservative here at the beginning, but the plan is actually based on about a $200 risk in the trade, as long as there's a low probability of realizing that risk. But this is beyond a low probability of realizing a $100 risk. Given everything that I've said, if you take the profit as it's going through the profit zone, you definitely have a 98% probability of not losing on this trade. And the maximum risk is got to be less than 1%, because the most bizarre situations, set of conditions have to occur in order for you to actually realize the $100 max risk on this particular setup. Now, the problem is, what if you're not filled on both those trades? And that's something that you'll have to consider based on what I am about to tell you with this. All right. So with this particular pattern, because the risk is only $100 and there's just a massively small probability of realizing that risk, you can actually do 2 units. You can combine this, and a trade size of 1 can actually be 2 units of here, because this compounding plan is based on, again, a max risk of $200. Low probability of realizing that. When I say low probability, I mean about 10-15% is acceptable. This has a much lower probability of realizing the $200 risk. And so it is well within your ability, once you start experiencing profits and taking, a $50 profit, a $60 profit, a $70 profit, as they come, whatever the case is, you can actually have 2 of these on based on this compounding plan. And so you go from 2 to 4 to 6 to 8 to 10 to 12 to 14 to 16 to 20, et cetera, et cetera. And you will actually start to average. Most likely, you'll be able to increase your average on this trade and this trade alone, this pattern alone. You should probably be able to bump your average up based on a 2-lot unit to $100 or more. Okay, again, there are going to be trades where you make $12 because the market tanked. And then there are going to be trades where you make $150 because the market's moving through the middle of the profit zone on Wednesday, and that gives you a nice solid profit on the trade. Depending on how far out it is, that profit zone is when you place the trade on. This one we placed on when the market was down, and we placed it on about 4 points out of the money. All right, so we placed this trade on. Let me pull this back over here. We placed this trade on when the market was trading around 316. All right, it was way down here. And so it had a long way to go to reach the profit, reach the max profit zone. And so the higher probability was in this area anyway. And if you put the trade on, like for example, this week we'll put the trade on much closer to the money. If you put the trade on much closer to the money, then you have a higher probability of seeing the market move up through the bigger profit zone, right? And if it does that, it depends on how soon it does that. If it does that fairly quickly, like the next day, you're not going to have as big of a profit, and you definitely want to take that profit at that point. And the reason you want to take that profit is because now you're getting closer to this risk. And so take that profit, and you might even be able to put on another trade, moving this whole thing up during the same week, moving this whole thing up several points, several strike prices. Nothing wrong with that. All right. So it depends on where the market is. It kind of gives you the probability of whether it's actually going to go through the big profit zone or not. But point being is that there's room to be more aggressive in this particular compounding table with my $1 million option pattern. Okay, with that pattern alone, if the and that's assuming that you are able to successfully put on both sides of the trade, and it's assuming a very low probability of realizing the $100 risk. Okay, now if you put on the bullish side of this, right, first, in order to make sure you don't give yourself, a $300 risk on a trade where the max risk is going to be 200, and then you do 2 of them. If you do 2 of them, at the same time, two bearish at the same time, then you're putting on a risk of about $600 to maybe even $700 or $800, depending on, again, what you're bringing in for the credit. So if you do a 2-unit on this and you're concerned about getting filled on one side, not the other, there are several things you can do. A, you can put on 1 bearish, 2 bullish, and then repeat the process. Or you can put on 1 bullish or 2 bullish, and then put on 2 bearish and then 2 bullish, as an example. Or you can do 2 bullish, 1 bearish, and 2 bullish and 1 bearish, if you want. And that's certainly possible as well. And you want to stagger it in that from that standpoint. Okay. So otherwise, if you don't do it that way, if you do it all at once, then what you're going to want to do is you're going to want to, as soon as you're filled on the first trade, you're going to want to make sure that you're filled on the second trade. And that may mean creating a small debit, 4 or 5 cent debit. That's certainly acceptable. There's nothing wrong with that. Obviously, you don't have a 98% chance of not losing at that point because there is a higher probability, more than 2%, that you might lose $4 or $5 on the trade if the market absolutely tanks, but it's barely even a glitch in the long scheme of things. And it's still a very low probability that you'll realize the entire debit on the trade. All right. So that gives you an idea. Now, having said all of that, more stuff to think about. And by the way, on this in the seminar, I'm going to be talking about how to dramatically increase the profit potential using the compounding plan without increasing your risk by very much at all, but it can only be used once you have gotten to a certain level. And I would say once you've increased 7 to 10 times, so that's the kind of success that you have experienced. You've obviously got a tremendous amount of experience under your belt at that point. If you're able to, of successful experience, if you're able to increase 7 to 10 times, then you can flip to the new, a little bit more aggressive, and you're talking about, instead of, if you average $50 a week on a single unit, instead of making 800,000 after 5 years, it actually could balloon to 7 or 8 million after 5 years. So I'll be giving you that little trick, if you will, in the seminar of how to, excuse me. I think I swallowed a bug or something. Nonetheless, once you, again, establish a track record and establish yourself as experiencing some success, you can flip over to that slight alternative way of doing this and watch your account grow potentially even faster. Okay, let's get to the trades. So right now, the current trade that we've been looking at is currently trading at the 84 cent debit. We're trading about 30 cents, 35 cents on the bearish, because the market is coming down, and we are trading at about $6 profit on the bullish now. So we're looking at basically still about a $50, a little less than $50 profit on this trade, with the market coming down. If the market stays the same by tomorrow morning, you should be looking at very close to a debit on this trade, and you might have a very small window where the bullish trade doesn't lose very much. But again, you risk the market going down to 315 and saying bye-bye to your profit if you haven't already taken profits on this trade. Okay. All right. So let's take a look then at Let's see here. I'm gonna put together the smart order file in front of you. Again, we're gonna be doing this pattern. I put on this pattern for next week yesterday, when the market was trading a little bit higher, and again this morning when the market was trading a little higher. And so it's almost always available on Thursday and Friday. Almost always, not quite. You may have to wait a little bit of time to get your credit, but most of the time it is going to be available. All right, so let's pull in the new one, and I'm going to label this TPO signals for 7/16/20. All right, so we'll save that. I'll come in here and I'm going to use next week's, obviously, and so I'll put those on here. And do I want to go in the money, at the money? Quite honestly, with we're trading down, I want to go 320. So basically the same exact trade, 320, 323, and 324 will be the long. And that's trading at a credit of $1.33. And that might change a little bit. So there we go, $1.52. That's more like it. So that's $1.52. And then the bullish side, again, if you follow the exact same pattern, what do you want? You want the long on the bullish side to be 1 point bigger. If you do the exact same pattern, 1 point higher than the long on the bearish. All right, so and then the short will be 2 points higher than that. And so we'll do the 327. Let me extend this. So we'll go, whoops, add the order. 227 or 327 will be the short, 325 will be the long, and what we're wanting those to be at 75 cents, 78 cents if we can get 78 cents. And so sell zone. So right now they're at 93 cents. So wow, that's actually quite a bit higher than it was earlier, which makes no sense whatsoever. So in order to get this trade, right now, we may have to go out of the money a bit. I did a 323, 326, 327 earlier. I don't know if that's going to be available right now because the market is down from where it was. So we'll go 322 and 325 and then a 326. All right, so that's about where we got filled. Well, let's hang on, see if that updates. And then we'll go 330 and 328. Let's see here, 330 and 328. Went right past it. All right, so that actually should be a 327. So hang on one second, 327 and 329. All right, so that's trading at 70. It's 116. Wow, you can't get that one either. So last week to get this trade, I actually had to put in a better price for the bullish. And I have no problem doing that because if this one is out of the money, I have no problem doing that. This morning I was filled on this trade, the 323, 326, 327, and then the corresponding bullish trade I was filled on at 98 cents on the bearish and 48 cents on the bullish. So what to do since you can't get both of these at the same time? So we can do this. We can try and go one more down, one more up, and see what we get. It's probably going to be around 58 cents for the bullish if we go up one on that. So we'll go 323, 326, and 327. So that's where I was filled at this morning. Interesting. And then the 330 and the 328. And I was filled at 48 on that this morning. So that's trading at 60. So we're talking about a 20-cent debit on this particular trade if we were to do both. So the thing about this one is the market, this is way out of the money. And so I might be willing to do this trade where I place on the bearish and then place on one bullish and then place on the second bullish at a better price. And that would probably still create a small debit, but and that's kind of the way, that's basically where they're priced at right now. Probably be better tomorrow, better pricing tomorrow. If we absolutely had to wait. Obviously, there is an economic report coming out tomorrow, so we don't want to be too aggressive on this. At the same time, the 325, 326, 327 is trading at a credit of 1, and the market's trading, it's 3.5 points out of the money. And so we actually have a very high probability of being able to get this trade, this bullish trade, either at a better price or get out of this one at a break even or better, and then reestablish the trade if we wanted to. So here's what I'm gonna do. I'm gonna go with order 3. And I'm gonna say, give me a credit of 1. And I'm going to do a 1 lot there, and then I'm going to say action order 2. If order 1 is filled, then I'm going to execute. Actually, that's order 3, right? If order 3 is filled, then I'm going to go with execute order 4, and I'm going to say at 60. And that will leave me with a total credit of 40 cents if I'm filled on the bullish. And then I'm going to say if order 4 is filled via action group 2. Okay, so if order 4, right, is filled via action group 2, then I'm going to say execute order 4 at a debit of 0.40. And I'm going to do that one as a GTC. All right, so that is one way of doing this. The other way of doing this would be to buy the bullish, one of the bullish, and then place an order to buy the bearish at a better price, let's say 120, and then put another order in to buy the second bullish. If you want to leg into these, otherwise you would need to get into both of these trades basically at the same time, and that would create a debit of about 20 on this trade, and that would mean a loss of $20 if the market tanks, and it would mean a less than, so on today's trade, for example, that we're in right now, if I were in at a debit of 20, where'd that go? If I were in at a debit of 20 instead of a $50 profit on this trade right now, I'd have a $30 profit on this trade, which is why I'm kind of a stickler about the overall prices that I'm trying to get on these trades. So if I can't, worst case scenario is I can't get in this. If I absolutely have to have the pattern and both sides traded because of my trade size, my overall risk, et cetera, then I may just wait until tomorrow and see if I can't get a better price on the bullish. Maybe the market moves up and I can be a little bit more aggressive on the strikes, et cetera, et cetera. Okay. The other thing to do when you run into a situation like this is to pull up PDS Trader and see if there's any other bullish trade that you might be willing to consider. Put it into the risk graph, make sure that you're not creating too big of a dead zone, and make double sure that your bullish side has a profit. Your bullish side has to have a minimum profit. You do not want to add a bullish trade that it will create a profit zone, but if the market, if there's risk to the downside, those profit zones you have to wait till the last minute. So a calendar spread, for example, are actually not very good for creating profit zones because you usually have to wait until the last minute in order to really benefit from the profit zone. So on the flip side, if you have a bullish trade where there is absolutely profit to the upside, minimum profit to the upside, then you don't have to worry about that quite as much. All right. So this is the one that I said I was going to put in place. We'll go ahead and save it. And then I'll turn it on. All right. While we're waiting to see if this any of this gets filled, I will. We should get filled on the bearish. In fact, I may get filled on the bearish and not the bullish because we've already moved away. So I was filled at $1, even though it's trading at $1.04. I was filled at $1. So now we're gonna have to wait and see if the market comes down a little bit to fill that bullish. Let's take questions. Let's see. Let's see. Ryan, so here's the question. I was showing a possible $200 profit with the in the middle of the profit zone. And yesterday I was showing a small loss, and today is a small $12 gain today. Why does it show a loss when in the middle of a huge profit zone with the downside quite far away? Ryan, my guess is because actually that's like almost read my mind of what I just said. My guess is because you probably used a bullish trade that does not have a significant profit potential to the upside. And those you have to wait until the last minute. And that's something, you know what, I think I'll cover that more extensively in Monday's call for you guys. Hey, can you explain the positions you have that expire tomorrow? Okay, I already did that. We go through the Monday, Wednesday. YM, we focus on the Friday, Monday. We're going to continue to focus on the Friday, Monday, Wednesday, Friday, Monday, Wednesday will come later. Because you can't get the same prices. And it's really as simple as that. All right, let's see here. I put together a pattern that offers a credit on both sides. 150 in the dead zone, 200 max profit peaks. Ryan M, yes, you can email me that trade. If you've put together a pattern that offers a credit on both sides, so in other words, you're not going to you're not going to lose money if the market moves down. You're not going to lose money if the market skyrockets. And you have a dead zone. The problem is that your dead zone is probably going to drop, and you're probably risking money in that dead zone. In fact, I would say there's a 98% probability that you're risking money in that dead zone. So you do need to be careful with that scenario. Email me the trade. I'll be more than happy to take a look at it. Just send it to support and say, please forward to Ryan at his request. All right, let's see. Getting in is easy. The stressful part is getting out. Hopefully that will make it easier for you, Keith. If ever in doubt, man, take the profit. So yeah. Should newbies be focused on one pattern and perfect it, or should we be trying to do more than one? You should be. So if you're a newbie, I'm going to point you to the report that you'll have access to in a matter of minutes. So the key is to start experiencing success. Period. That's your first goal. That is step number one. Period. End of story. Don't try and put these fancy trades together, hoping you're going to make $400 this week. Make $20 this week, then make $30 next week, then make $40 the next week, and then $50 the next week. That's where you start. That will dramatically improve your long-term efficiency with this thing. All right, let's see. It says on Tuesday, similar entry as you have. I'm currently seeing a loss right now. Then you don't have the same exact pattern that I have. You can't. You have something different, because it's impossible for you to put on the same exact pattern that I have on right now at the same price and be showing a loss when I'm clearly showing that it's a profit, right? So what you need to do is you need to take a look and say, okay, what is the difference? Let's see. So Stephen, your first issue is that you don't have the same trade on as I do. All right, let's see here. You have a rule of thumb when wearing risk to the upside, for instance, if we're at 321 on Wednesday and your breaking is 327 max loss. All right, so wow, I think I went through that. I think Ryan J, another Ryan J. I think I answered your question during the presentation, so if I didn't, let me know. The confusion from last week was that you initially sent out over a smart order that entered the bearish first, but there was an error on the bullish. Oh, that's right. John, thank you for reminding me about that. I had an error on the bullish, and then I had to send out the bullish in a separate file. But I think I was still filled on that separate file. I'll have to go back and look on that one. Nonetheless, all moot now. And by the way, that's why I go through this process of me putting together these trades so you can see them. You know what to look for. So always double check before you just turn the system on, because I am not incapable of making mistakes, especially when I put these files together, in front of you while I'm talking and distracted and whatnot. All right, let's see here. So John S., you got in on the bullish trade at 35. Okay, excellent. Why, if the market opened at 325 today, would you be at a profit of 175, between 150 and 175? Wouldn't the bearish be losing then? Yes, the bearish would be losing then, but it would not be losing as much as the bullish is making. And that's why. So the great thing about these bearish trades is that you're not going to come anywhere close to a bigger loss until right before the close on Friday, or maybe maybe a couple of hours into Friday morning's action. And so even though the market, if the market were to move up to 325, the loss would not be tremendous. But I would absolutely have a significant gain on the bullish. So let me show you something here. So let's do this. I'm going to bring in, maybe I will, maybe I won't. Nope, I will. All right, so one second. I'm going to bring this down here, and I'm going to just use this kind of as a price quote, if you will. And I want to say, all right, so we are long, let's say short that and long that. So this is our bullish. This is our bullish, all right? This is where the bullish would be if it were at the money, or right actually in between the two. So if the market moved up to 326, we could expect our bullish trade to be worth $1.90-ish a piece. And I was in at excuse me, just 42 cents. So at that point, you're making $150 a piece on the bullish, and that means you're making $300 on the bullish. So as long as you're not making losing more than $150 on the bearish, and that's about probably the max about where you would expect that to be, you'll be looking at $150 profit. Okay, that's why. And by the way, if you're still in this trade tomorrow and the market moves up to 324, 325, you better get out of those bullish trades minimum, and then put a better price at the on the bearish side of it. Okay, apparently you guys are making some different trades that I am not sure about what you're making, because there are several of you who said you've put together a trade and you have a loss. And so there's something that you're missing, and I need to figure out what it is you're missing. So Mike M, I'm going to request that you send me your trade as well. In fact, every single one of you, if you're in a trade right now and you're losing money, you absolutely should not be. So send me your trade. I want to see what you're doing, and I want to be able to guide you and correct your mistake. And this is what I'm seeing here is just all the more reason why I put together that report, because I think y'all are trying to do a bunch of different things, and you're not ready to be doing a bunch of different things yet. That's my guess. Ryan J, I've noticed in the pattern that if you push the bullish out one more strike, you can often complete the trade for 2-to-1 immediately. Do you not like this idea? Actually, I do like this idea, Ryan. And I almost suggested it, but then I think I got distracted on something. So what Ryan is saying is, let's see, on this one, right, I got filled at 1, and if I were to, I can't do that. I can't do that on this one, so I'll do it on this one. All right, so we'll just make this a 724 and a 727 and a 320, 331, 331, Ryan. Let's see here. And a 329. All right, so this is the bullish. That is one strikeout above. That is a pain in the rear. one strike out above, and you can see here I can immediately get that bullish. Well, it's going to update here. It's probably a little bit more. There we go, 55 cents. So that one's not quite there, but it was trading at 50 cents. A few minutes ago, market has moved up to 320.15-ish, so that one's trading a little bit higher. So Ryan is saying that I could push the strikes up one more and get my price, and that is correct. You absolutely can do that, and I'm not opposed to doing that when the market is up the way it is up right now. Considering all the factors and conditions that were, of course, the market continue going up. But the problem is that this is going to provide a smaller profit potential, and in the profit zone, and you might actually even be creating a very ever so slight dead zone, and you want to make sure that you're not holding on to this until the last minute under any circumstances. So if I were to put this down, the current bullish, if I were to take it down just 2 strikes, so let's say, so that the market is not quite there. All right, so we'll go that one to 321. We went from $1.80 to $1.40, $1.47, right? So this is so there's going to be about a 20-cent difference each, and so you still have a solid trade. It's just not quite as good. Your profit potential in the profit zone is not going to be quite as much as it would if you were to get the other trade. Okay. Let's see. So in order to avoid the volatility crush, which I've stated from the beginning happens, so you shouldn't be shocked. The way to avoid that is by implementing a target and making sure that you put together trades that are not going to be at losses due to a volatility crush based on a dead zone, and don't hold until Friday. That's the best way to approach that. Yes, not counting tomorrow. The next Monday will be next webinar will be on Monday at 2 p.m. That is correct. Any update on TOS? They implemented another piece of that today. TOS on Trade Partner, actually yesterday. So they're working hard on it. On your three-legged trade, how do you determine where to place the buy? It's really not a matter of where do I place the buy. It is what it is. The question is whether I can get my bullish trade, whether I can get my bullish trade for it. Right, that's the question. So if I get $1 on my buy, then obviously I need my bullish trade to be 50 cents or lower in order to create no debit. I might be willing to go 52, 53, 54 cents, somewhere around there on the debit in that instance. Let's see. What were you watching to see your fill confirmations? Well, I watch. So obviously, my platform lets me know. So I was filled at $1. It's now trading at $1.10. Market's trading up about 75 cents from when it was filled. Let's see here. Would you be able to walk us through a simple trade with buying all legs at the same time with $150 risk at this very moment. I will put that in my notes for Monday. Let's see here. So on Monday, if you'll recall, market was trading higher, and I placed on another pattern, right? Only I did one bullish, not two, and created a credit. And that was in addition to the trade that we already had on, right? So yeah, you can add to these, no question about it. You can add to them, and so on this one, for example, as long as I got into my bullish, I wouldn't add to this trade if I didn't get into a bullish trade. But if I wanted to get into another trade, I would go ahead, as long as I was in my bullish, I would go ahead and put the order in at 326, 329, and 330. So 3 strikes higher, and I would say get me in at a credit of like maybe 90 cents, and then put my bullish on based on that as well. Okay. Send us support at paydaystocks.com and say forward to Ryan. Forward this to Ryan per his instructions. Is it okay to enter the bearish? The lowest short is in the money if you want to add the bullish and the market moves down. Jeff, yes, it is. But you have to understand that you are playing a bearish neutral trade at that point. Generally, if the market is, if the bearish neutral is in the money or at the money, if it's in the money, it's going to be more difficult to get the corresponding bullish trade. Let's see, will you be showing another trade tomorrow, sir? Yes, I will show another trade tomorrow based on wherever the market is trading and wherever the prices are at. All righty. Looks like I got all the questions, and within moments of me getting off of this call, I will be posting the new report, and I think it will help simplify some things a lot. For those of you who've taken trades, please send me your trades. If you are showing a net loss in your trades, I want to see what you're doing wrong and be able to address that and point you in the right direction. All right, everyone, have a wonderful weekend. If you're on the call tomorrow, I'll see you tomorrow. If not, I'll see you Monday.